Welcome back to Lamb's Cryptoverse. Today I'm going to talk to you about what I think is investors grasping at straws. Everyone, every day, is talking about a new narrative, and that's that we've had capitulation. Some people are saying we had a rolling capitulation. Why? Because Cathie Wood stocks have been declining since peaking in February of 2021, and growth stocks started declining, and overall market's been declining like forever. And if you look here, I'm going to minimize myself. If you look up here at this, today's headline, it says, fund managers scream capitulation as cash piles jump to dot-com crash levels. And then if you go there, I'm not going to read this to you, but if you go down here, it says that average cash allocations have reached 6.3%, the highest since April 2001. Well, first of all, you can't just clutch on one data point. Second of all, short-term rates are high now, so maybe we should adjust for that, right? Because if short-term rates are high, that's going to cause cash allocations and savings deposits and CDs to be higher. But despite, I don't want to talk about it. I want to talk to you about capitulation. People are pointing at capitulations in different parts of the market. I don't see that. Now let's go to equities. Let's look at sentiment. Here, starting on September 21st, and this is from AAII. They do a sentiment poll, and anyone can join it. Basically, starting in September, we had the highest percentage of bears, retail bears, in history, or one of the highest. And this usually precedes major bull markets. So in other words, this usually is when we have capitulation and a bear market bottom. Let's look at the crypto market. Fear greed index. There are multiple versions of this. Like I said, there are many versions of this, but this is the one that a lot of people look at. This is from alternative.me, and it says that as of today, even though the market is up, stock market is up, we were at an extreme fear level. And it looks like we've been, I'm going to get some historical data here. It looks like we've been at an extreme fear level like forever, right? Since the beginning of this year, right? I mean, look at this. We had a low of 6 in June of 2022. So I want to talk to you about what Glassnode did today. So right now it looks like we've got a lot of fear in the market, and this usually precedes a bull market. And I'm even thinking that we can go up for a few days or even weeks. But I'm going to sound like I'm contradicting myself here, because I think once we go up in terms of equities and Bitcoin, once we go up for a few days, let's just keep it at a week, for example. After that, I think we can have a major decline in both Bitcoin and stocks. And I'm going to show you why. So if you remember, I was talking to you about CryptoQuant, that I saw a problem with the leverage ratio. If you look here, maybe I should expand this. So if you look here, I put it in the middle, the leverage ratio is at an all-time high. We're about 40%, something like that. And this is after the Terra Luna crisis. My friends, this should have declined. This leverage ratio should have plummeted to all-time lows after the Terra Luna crisis. And what Glassnode did today is they dug deeper to see what's going on. And they talked about a few things today. And so I want to talk about them with you. Let me just adjust this here. What they talked about is not just what I mentioned earlier, the futures market, but they talked about something related to that, and that's volatility. So what I want to show you first is volatility visual, like what you can see with your own eyes without actually getting the percentages and the VIX and all that jazz. And you can see here, according to Glassnode, the week 42 high was not even 20,000, and the week 42 low was not even 18,000. So we're in a very tight range. And if you go back, it looks almost like what William O'Neill would call cup and handle, or it looks like a very good bottom formation. And I would say that too, but the problem is I don't think the macro damage from the Fed is done yet. And we have a very low period of volatility. So this period, this flat line here, this low volatility of Bitcoin is scaring me. To me, this is like the calm before the storm. And what Glassnode did is they dug down into the futures market and volatility market to see what it means, and maybe there is some bullish tidbits to be gotten out of here. So I'm going to focus on that. So here, the first one I want to show you from Glassnode is a 1 week realized volatility. So remember, this is historical volatility. And what they've noted, and maybe I should move myself to the left here. What they've noted in Bitcoin is that we're at a historical low realized volatility. And they note that by putting a green horizontal line. And so we have 28% volatility in Bitcoin. And if you go back, that could be very good, but it could be very bad. But they've given both examples. And I think it was June 2015, and they denote this in blue, in the blue horizontal bars. We had a big increase in Bitcoin price after that low volatility period. But then, oh no, not then. And also in, I think it was August of 2015, we had a substantial increase in the price of Bitcoin after that period of low realized volatility. But look over here in 2018. It's in around, I'm trying to give you a good date, around September of 2018, maybe before that, August 2018, denoted by these blue bars, vertical bars. We had a very low period of volatility. And what happened to Bitcoin? It plunged. It plunged something like 50%. And what scares me is not only that, but if you look at the chart looks eerily familiar with what we're seeing today. So I think what we're seeing today is the beginning of what could be a plunge in Bitcoin's price. So don't let this period of low volatility fool you. So it could be either a good thing or a bad thing. And I'm giving you both points of view in actual history so you can make your own decision. So let's go to another one. Now this is different, and let me just move my video to the right. So what we discussed earlier was 28-day historical volatility. Now what we're looking at is implied volatility, calculated using the options model, like for example the Black-Scholes-Merton model. And this is shown implied volatility. And usually this implied volatility is a forward-looking volatility going forward 30 days. But regardless, the point is that, again, we're at historical low volatility. And if you go back in if you go back to April 2021, this period of low volatility was just before Bitcoin prices plunged. But if you go to July 21, this period of low volatility preceded higher prices in Bitcoin. But if you go to the period of very low volatility in January 21, Bitcoin prices declined. And again, they declined from the period of April 22. So what I want to say here is if you look historically, periods of low implied volatility can go either way, but most of the time, low volatility denotes a period or calm before the storm, meaning a calm before Bitcoin prices plunged. And you can look at that yourself. You can see it yourself. So let's go to the next chart. Now here, since we're talking about derivatives, I want to talk about futures. Glassnode was talking about how futures trading volume is low, meaning there's a lack of interest, which usually denotes a long-term bottom in a bear market. I don't believe that's the case. I think it's too early to say that, but I wanted to show you that futures trade volume indeed is very low, and this is similar to what we hit in market bottoms. What worries me, and I talked to you about this earlier, is what I showed you from CryptoQuant. Do you remember CryptoQuant is showing that total estimated leverage in crypto is at an all-time high. And if you look here at the futures open interest, again, Glassnode is highlighting that open interest is at an all-time high. And to me, this doesn't make sense. We should be at an all-time low post the Terra Luna crisis. So I wanted to show you that. And let me just make it smaller so you can see the dates here. And you can see the Terra Luna crisis occurred around May 2022. And since then, we've gone up, and they've actually, Glassnode has even highlighted this. We've gone up 80% in options open interest. This, my friends, makes no sense. And so Bitcoin tries to explain that. Maybe they're reaching for straws, but they're trying to explain that, saying that, hey, maybe this open interest is more conservative than it was previously. And here's how they're showing you that this increase in open interest may not be as bad as it looks. If you go back to the March-April 21 period, collateral backing crypto margin open interest was crypto. So there was a lot of Bitcoin backing those futures contracts. But now, starting in 2022, especially in by the third quarter of 2022, basically now, there's been a lot of cash margined open interest. In other words, speculators are using more conservative they use a collateral, I should say. They're using cash to collateralize their open interest. So that is a good thing, I have to say. That is a more conservative way of backing their futures. But the thing is, I'm not convinced, because I'm seeing other data saying otherwise. So you see some good things, some bad things. It's all mixed up. And I already mentioned this. One thing I do want to mention is this. Do you remember I talked to you about we see some good things and bad things? Well, here's one example. So I just showed you that there's been more conservative collateral. We've got cash collateral versus crypto versus Bitcoin and crypto collateral on the futures market, on the open interest market, on open interest. However, this is very concerning to me. This is from theblock.com via Genesis Volatility, if you could look here. This is basically, I believe it's Deribit data. But what it's showing you is that the Bitcoin put to call ratio is quite low, at a historically low ratio of 0.5. And what's even worse is this. Ethereum, and I like this look, it's only showing Ethereum here. It's not showing other altcoins. So I like to use Ethereum as a proxy for altcoins. And what it's showing is that Ethereum's put to call ratio is only 0.2. So from a contrarian point of view, this is very concerning. This means that there are very few speculators buying puts in terms of options. So this is a very scary thing. So we're not getting any indication. I'm not getting any indication that Bitcoin is bottoming. I think maybe we've got a short-term bottom, and that's based on sentiment. Remember, I did a video on short-term charts versus long-term charts, and I used sentiment as an example of a short-term indicator. Now let's look at some other markets. And if you look here, this is the high in blue. It's the high yield index option adjusted spread. This is the old B of A / Merrill Lynch high yield market. And remember, this is not high yields. This is the high yield spread. That's a really good index because it measures credit premiums. And if you look here in blue, we're too low. We're at around 5%, I believe. Yeah, 5.4%. So this is not showing capitulation or panic at all. We need to get to 2020 levels or 2008 levels where it was 20%, or by the very least, we need to get to 2002 levels where it was 10.6. So I see no indication that we hit capitulation or market bottom in high yield. So how about equities? The same thing. I see no indication, and this is the VIX, that the VIX is around 31. I see no indication that we've hit capitulation or market bottom in equities. It needs to be twice as high. And what they're showing here is the average VIX, because I've seen it much higher. So it's showing here that the VIX was 54 in March 2020. I think it was even higher intraday, maybe 70. But basically, we're halfway. And if you look at 2008, we were, according to this chart, we're at 60. I think it was actually 80 back then. And we didn't even hit the 2002 level. So again, there is no indication whatsoever that we hit a capitulation in crypto, specifically in options, specifically in futures, or in equities. We see no indication that we hit a market bottom in equities or in high yield. The only area where there's a small evidence of capitulation is in global sovereign bonds. We saw that issue with the pension funds in the United Kingdom, where interest rates went up rapidly in the UK, and they actually meaning they pushed our interest rates higher. So there was some dysfunction in the treasury/sovereign market. Otherwise, I see no evidence at all of capitulation. Well, if you like this, please like us and subscribe to us. And thank you for coming back to Lem's Cryptoverse. Bye-bye.